Imagine a company that survived the American Civil War, a company that navigated the total collapse of the Southern economy, weathered the Great Depression, and outlasted two world wars. For 158 years, the name Lehman Brothers was synonymous with the very bedrock of American capitalism. But on a single Monday morning in September 2008, that bedrock shattered. In the largest bankruptcy filing in human history, $639 billion in assets evaporated. It wasn't just a bank failing, it was the spark that set the global financial world on fire. 25,000 employees lost their livelihoods. Trillions of dollars in global wealth vanished. How did a small grocery store in Alabama grow into a global titan? And why did the world's most powerful regulators decide to let it die? Was it a calculated murder by the government or a slow, arrogant suicide by its leaders? This is the definitive story of Lehman Brothers. Our story doesn't begin on Wall Street. It begins in 1844 in the dusty heat of Montgomery, Alabama. Henry Lehman, the son of a Jewish cattle merchant from Bavaria, arrived in America with nothing but a dream of the New World. He opened a small dry goods store. He sold shovels, fabric, and seeds to local farmers. In 1847, his brother Emmanuel joined him, and in 1850, the youngest brother, Mayer, arrived. They officially formed Lehman Brothers. In the pre-war South, cash was a rare commodity. Farmers often had plenty of crops, but no paper money. The Lehman Brothers made a pivot that would define their legacy. They began accepting raw cotton as payment for their goods. They weren't just shopkeepers anymore. They were cotton factors. They built warehouses. They understood that the real value wasn't in the shovel sold to the farmer, but in the crop the farmer produced. By 1858, the center of the cotton trade had shifted to New York, and Emmanuel Lehman moved north to open their first branch at 119 Liberty Street. The Civil War nearly destroyed them. Their southern assets were in ruins, and the cotton trade was paralyzed. But the Lehmans were survivors. After the war, they didn't just rebuild, they reinvented the market. They helped found the New York Cotton Exchange, the first of its kind. By the late 1880s, the brothers realized that America was changing. The Industrial Revolution was hungry for capital. Under the leadership of Emmanuel's son, Philip Lehman, the firm transitioned from trading commodities like cotton and coffee into investment banking. Lehman Brothers became the bank for the American consumer. They partnered with Goldman Sachs to take legendary companies public. When you bought your first suit at Macy's or your first refrigerator from Sears, Lehman Brothers was the engine behind the scenes, making it possible. For decades, the firm was a tight-knit family partnership. They weren't just managing money, they were managing their own family's reputation. This skin in the game kept them conservative, resilient, and respected. Little did they know, a century later, that family culture would be replaced by a culture of the guerrilla. By the mid-20th century, Robert "Bobby" Lehman had turned the firm into a global powerhouse. When he died in 1969, he was the last Lehman family member to lead the company. The partnership era was ending, and the era of the corporate titan was beginning. In 1984, after internal civil wars between traders and bankers, Lehman was acquired by American Express. It was a miserable marriage. The gritty, aggressive culture of Lehman clashed with the white-shoe corporate world of Amex. In 1994, Lehman was spun off once again as an independent firm. Enter Richard "Dick" Fuld. His nickname was the Gorilla. A former star high school squash player and a ruthless trader, Fuld took over a company that many thought would fail within a year of its independence. Fuld didn't just want Lehman to survive, he wanted it to dominate. He fostered a U.S. against the world mentality. Under Fuld, Lehman became the leanest, meanest, and most profitable firm on the street. Between 1994 and 2007, Lehman's revenues skyrocketed 600%. But the secret to this growth was a dangerous drug that the entire financial world was addicted to: leverage. To understand why Lehman Brothers collapsed, you have to understand the housing dream. In the early 2000s, interest rates were at historic lows. The U.S. government wanted every American to own a home, and Wall Street found a way to make that dream incredibly profitable for themselves. Historically, banks were careful about who they lent money to. You needed a job, a down payment, and a good credit score. But Lehman Brothers, led by the aggressive vision of Dick Fuld, saw a way to bypass these old-fashioned rules. They didn't want to just wait for banks to give them mortgages to sell. They decided to buy the mortgage companies themselves. This was the birth of the originate-to-distribute model. Lehman acquired lenders like BNC Mortgage and Aurora Loan Services. These companies specialized in subprime loans, loans given to borrowers with subprime credit. Why would a prestigious bank want bad loans? Because of a process called securitization. Lehman's quants, the mathematical geniuses in the back rooms, would take thousands of these risky mortgages, bundle them together into a pool, and slice them into different layers called tranches. The top layers were rated AAA by credit agencies, supposedly as safe as government bonds. The logic was that even if a few people defaulted on their homes, the entire pool wouldn't fail. Lehman was the king of this market. Between 2004 and 2006, they were the top underwriters of mortgage-backed securities in the world. They were making billions in fees. But there was a catch. To keep the machine running, they needed more and more mortgages. When they ran out of good borrowers, they moved to ninja loans. No income, no job, no assets. As long as house prices kept going up, everyone was a winner. Lehman was no longer a bank, it was a high-speed assembly line for debt. Inside the walls of 745 7th Avenue, the culture was becoming legendary. It was tribal. It was Lehman versus the world. Dick Fuld, the gorilla, demanded total loyalty. He famously told his staff that he wanted to reach in and rip out the hearts of his competitors. At other firms like Goldman Sachs or Morgan Stanley, there was a certain level of white shoe decorum. At Lehman, it was at the P&L, profit and loss. If you made money, you were a god. If you didn't, you were invisible. This culture led to a dangerous obsession with leverage. Leverage is essentially using borrowed money to increase your betting power. By 2007, Lehman's leverage ratio hit a staggering 31-to-1. Think about that. If you have $100 and you lose $3, you still have $97. But if you have $3,100 of someone else's money and only $100 of your own, a tiny 3% drop in the value of your assets wipes out your $100 entirely. You are bankrupt. Lehman was walking on a tightrope across the Grand Canyon, and they were carrying $600 billion on their backs. And in 2007, the wind began to blow. The first sign of trouble came not from Wall Street, but from the suburbs. People started missing their mortgage payments. Foreclosure signs began to sprout across the American landscape. In early 2007, the subprime lender New Century Financial collapsed. The toxic loans that Lehman had bundled were starting to rot. Investors began to panic. They didn't want to buy mortgage-backed securities anymore. This created a liquidity trap. Lehman had billions of dollars worth of these loans sitting on their books, waiting to be sold. Suddenly, there were no buyers. These assets became stale. But instead of selling them at a loss and moving on, as Goldman Sachs began to do, Lehman's leadership refused to believe the party was over. They continued to buy. They even started investing in commercial real estate, buying up skyscrapers at the very top of the market. Dick Fuld and his president, Joe Gregory, believed that Lehman was special. They believed they could outmuscle the market. But the market is an ocean, and no matter how big a gorilla you are, you cannot stop the tide. And in 2008, the tide claimed its first victim, Bear Stearns.
March 2008 was the month the world realized that the subprime flu had become a terminal illness. Bear Stearns, the fifth largest investment bank and a fierce rival of Lehman, was experiencing a classic bank run. In the digital age, a bank run doesn't happen with people lining up at the door. It happens with a few clicks of a mouse as hedge funds pull their collateral. In a single weekend, Bear Stearns vanished, sold for a measly $2 a share to J.P. Morgan Chase in a deal brokered by the Federal Reserve. The message to Wall Street was clear. The government would intervene to prevent a total meltdown, but they wouldn't save the shareholders. For Dick Fuld, the fall of Bear Stearns was a call to arms. Instead of seeing it as a warning to deleverage and raise capital at any cost, he saw it as an opportunity. He believed that with Bear gone, Lehman would inherit their market share. However, the short sellers, investors who bet that a stock price will fall, had a different idea. They smelled blood in the water. With Bear Stearns out of the picture, Lehman Brothers was now the smallest and most vulnerable of the big four investment banks. The target was now painted squarely on the back of the green turquoise logo. To understand why Lehman couldn't just wait out the storm, you have to understand the repo market. Investment banks like Lehman don't keep billions of dollars in cash under their mattresses. Every night, they borrow the money they need to operate the next day, using their assets, like those mortgage-backed securities, as collateral. It's a game of trust. As long as the world believes your collateral is worth something, the money keeps flowing. But by the summer of 2008, the world stopped believing. The toxic mortgages on Lehman's books were being valued lower and lower. Desperate to look healthier than they actually were, Lehman began utilizing an accounting trick known as Repo 105. Here is how the magic trick worked. Just before the end of a financial quarter, Lehman would sell $50 billion worth of assets to banks in the UK with an agreement to buy them back days later. Because of a loophole in accounting rules, they could classify these loans as sales. This allowed them to temporarily move debt off their balance sheet, making their leverage look much lower to investors and regulators. It was financial plastic surgery. It hid the wrinkles, but it didn't cure the underlying disease. When the quarter ended, the debt came roaring back onto the books. It was a lie of omission, and it was a sign that the gorilla was starting to panic. By August 2008, Lehman's stock had lost 70% of its value. Dick Fuld knew he needed a white knight, a massive investor to swoop in and inject billions of dollars in fresh cash to keep the firm alive. He turned his eyes toward the east. Negotiations began with the Korea Development Bank, KDB. For weeks, the financial world held its breath. A deal with the Koreans would provide the capital cushion Lehman desperately needed to survive the year. But Fuld's legendary arrogance was his undoing. Despite being in a position of extreme weakness, he played hardball. He refused to sell the company at a fire sale price. He believed Lehman was worth its book value, while the rest of the world saw a house of cards. On September 9, 2008, KDB walked away from the table. The news hit the wires like a bombshell. Lehman's stock plummeted 45% in a single day. The Hail Mary pass had been dropped. There were no more buyers, no more tricks, and no more time. As the sun set on Friday, September 12, 2008, the employees of Lehman Brothers headed home for the weekend, many unaware that they would never return to their desks as employees of a solvent company. While the rank and file went to dinner or stayed home with their families, the most powerful men in finance were being summoned to a somber meeting at the Federal Reserve Bank of New York. The Lehman weekend had begun. It would be the most consequential 48 hours in the history of modern finance.
The gorilla was trapped, the government was losing patience, and the global economy was about to look into the abyss. Friday night, September 12, 2008. While most of New York was heading out for the weekend, the titans of Wall Street were being called to a meeting they would never forget. The heads of Goldman Sachs, Morgan Stanley, J.P. Morgan, and Citigroup were all there. Treasury Secretary Hank Paulson and New York Fed President Timothy Geithner had a simple, brutal message. Lehman Brothers is failing. There will be no government bailout. You are the ones who have to fix this. Paulson was adamant. After the public outcry over the Bear Stearns bailout and the takeover of Fannie Mae and Freddie Mac just a week earlier, the moral hazard was too high. The government refused to use taxpayer money to save another group of wealthy bankers. It was a game of musical chairs, and Lehman was about to realize there were no chairs left. There were only two possible buyers left on the planet: the British giant Barclays and the American powerhouse Bank of America. Throughout Saturday, teams of lawyers and accountants from all three firms pored over Lehman's books. What they found was a nightmare. Lehman's real estate assets weren't just troubled, they were toxic. Bank of America's CEO, Ken Lewis, looked at the $60 billion hole in Lehman's balance sheet and realized that buying Lehman would be like jumping into a sinking ship. Then came the ultimate betrayal. While Lehman was waiting for a call from Bank of America, Ken Lewis was on the phone with someone else. John Thane, the head of Merrill Lynch, saw Lehman's corpse and realized his firm was next. He offered Merrill Lynch to Bank of America on a silver platter. By Saturday night, Bank of America walked away from Lehman to buy Merrill. Now there was only one: Barclays. Sunday morning, September 14th. A deal with Barclays was actually on the table. They were willing to buy the good parts of Lehman, but there was a legal hurdle. Under British law, a bank cannot guarantee the liabilities of another firm without a shareholder vote, a process that takes weeks. Barclays needed the UK government to waive this rule. In a final, desperate phone call, the UK Chancellor of the Exchequer, Alistair Darling, spoke to Hank Paulson. The British message was clear: we are not going to import your American cancer. The deal was dead. At the New York Fed, the room went silent. One of the lawyers present later remarked, the look on everyone's face was the look of people who had just realized they were standing on the tracks and the train was 5 feet away. In the early hours of Monday morning, September 15, 2008, the board of directors of Lehman Brothers Holdings Company met via conference call. There were no more options, no more Hail Marys, no more Repo 105 tricks. At 1:45 a.m., Lehman Brothers officially filed for Chapter 11 bankruptcy protection. It was a document that listed $639 billion in assets and $619 billion in debt. It remains to this day the largest bankruptcy in the history of the world. When the markets opened a few hours later, the Dow Jones Industrial Average plummeted 500 points, its largest drop since the 9/11 attacks. But the stock market was just the beginning. Did the company fail? Yes, but it didn't just fail, it detonated. Because Lehman was a counterparty to almost every other bank in the world, its bankruptcy froze the global plumbing of finance. A major money market fund, the Reserve Primary Fund, broke the buck, meaning it could no longer guarantee that an investor's dollar was worth a dollar. This triggered a panic worse than the 1929 crash. People often ask, why did the government let it happen? The official answer was that they lacked the legal authority to bail out an insolvent firm without a buyer. The unofficial answer, they wanted to set an example. They wanted to show Wall Street that big to fail was a myth. They were wrong. Within 48 hours, the government was forced to bail out the insurance giant AIG for $85 billion. The Lehman experiment had nearly destroyed the world.